the tube. We are live on the YouTube. Live on the YouTube. Let's talk about the life.
Okay, everybody, you know the drill. Load up the chat box with all your questions about buying houses, about loan programs, about the economy, interest rates. Ask us all the questions and thoughts that you have on buying houses right now, even selling houses, because we're going to help in a lot of different areas just like that. So thank you for the hearts already. I love that. We're trying to get to 10,000 today.
Appreciate
so
the
help
hearts.
us get to 10,000 if you can. But load up that chat box, guys. We want to answer all your questions and entertain you at the same time, because I'm funny and he's funny
Good
too.
looking.
Funny. See, I told you he's funny too. Hilarious.
So, his job is to be funny. My job is the eye candy. That's how it works.
And he's delusional. But that's what we're here to do, guys. Answer all your questions and hopefully have a laugh or two. I want to laugh. Help me laugh.
That doesn't look healthy.
Tell me a good joke. Anybody, tell me a good joke. So what's going on, man? What do you know? I seen a guy get his hand cut off on TikTok.
What? On TikTok?
Yeah.
You can't watch that shit, man. It'll mess your head up.
Yeah, they were machete fighting and he got his hand chopped off.
And they showed it on TikTok?
Yeah.
That's crazy,
and
man.
he goes over and he picks it up. It's pretty weird.
How's that anything
Pretty
to do with
strange.
loans? How's that
Well,
anything
that's
to do with
what's
loans?
going on, man.
That's what happens to the builders when you go to the builders and you're like, hey,
Fucking that stuff
I
up.
want you. It's not working. I want you to watch my loan. And they're like, shoo, and there goes your hand. That quick.
Oh, yeah. Oh, yeah. All right, guys, what are your questions about real estate today? We have a lot to talk about. Ooh, nice.
What questions do we got?
We don't have anything so far.
Yes, we do. We're on TikTok, Facebook,
check these.
Instagram, and YouTube. Working to get you.
Okay, here we go. Buying a house in New Jersey. Can you guys help me with first-time home buyer? I have about $20,000 in the bank, and I make about $120,000 a year. How much can I afford?
New Jersey. Love New Jersey.
Jersey.
Joyzy. So most down payment assistance programs, they are local driven. Most of them. Like if you're in California, you got CalHAPA. If you're in Texas, you have the Texas version. However, there are a few programs that are national, but they're only national because they're sponsored by a bank. Right now, we've got a program that's in all 50 states. This is some good news here. All 50 states. Down payment assistance program goes all the way down to 600 FICO. 600 FICO. What's the name of it?
I don't know. It's our proprietary program. So it's the Pathway 100.
Pathway 100.
Yeah.
And the only one who offers that is New American Funding. It's a New American Funding proprietary product. And there's a lot of them out there. There's a lot of products out there. There's CalHAPA, Shadaf, Shanoa, Sapphire, name a few. Yeah, good job. So there's a lot of programs out there, but the one that goes for all 50 states, CalHAPA. Or not CalHAPA. What was it?
Pathway.
Pathway.
Yeah, so if you want down payment assistance, guys, this is probably the best route to go. Okay, here's something that's really cool. When you do a down payment assistance program, state, city, county, that's the most popular. There's an origination fee on that, and usually it's somewhere between 1.5% of the loan amount to 2.5% of the loan amount. Which means you're going to pay thousands of dollars more, or you're going to borrow thousands of dollars more, or you're going to need closing costs, credits, or come out of pocket thousands of dollars more. The one that we're talking about, the one that's here that's proprietary, doesn't give you that extra origination fee. So not only can you go down to a 600, it's cheaper out of your pocket. You can go to your normal income, debt to income ratio limits, which means, let's say I have you qualified at 500. If you go with a regular county, city driven program, it's going to drop you to probably 380,000. But this one will keep you at 500. So lots of cool benefits to that. But we got a bunch of questions. Go up top.
Yeah. So here's a question, real quick. That sounds a little too good to be true, and we're real big on the honesty of the down payment assistance programs. What's better, Fannie Mae, Freddie Mac, FHA? What's the downside of this program? I mean, if you're honestly slicing up the downside, what's the downside?
Okay, I have a different opinion about this
Okay.
because I know a lot of people knock the down payment assistance programs because you have to pay them back. Well, you can do two things. You can put the money up front, or you can use this program and pay it later. So either way, you're paying the money. So from that perspective, I don't consider that a downside. But with all the down payment assistance programs, doesn't matter which one you go with, you will have a slightly higher interest rate. And that slightly higher interest rate does push down how much you can buy. So once again, if you're at $500 with this program, you probably qualify for $520. So there's a $20,000 push down as far as getting a down payment assistance program.
So that sounds like one of the better ones overall. I mean, because if you ask me
I
what's
think
the
so.
downside of Cal-Hafa throttles back your buying power. If you ask me what's the downside of Platinum, the interest rate's so high and you can't get out of it because they'll penalize you if you get out of it. Like, all of these have a down payment issue when you use a down payment assistance program. But it sounds like the proprietary one is better than like all of them. Is that correct? You think
I
so?
would say so. Jason, I can confirm aliens are real. I live next to a family of them.
Jason, I want you to join our live more often because you sound like a lot of fun.
And what is the confirmation on this? You see the spaceship?
And what connotation are you using alien? Because it could be somebody from not our country that is an alien and you live next to him, and that's how you could be saying,
I didn't even
hey.
reach for that.
Yeah, I did because it sounds like Jason Doe's going to be a lot of fun. Anyway, what do we got?
Barrow 60. Would it be wise to sell to an investor if my realtor can't get my house sold?
Okay, so Barrow, this is a dangerous area. Dangerous. Here's why. Because if you have a realtor has a license number in it. And the license number their job is to protect you. It's not just to make a commission. That's what realtors get a kind of a bad rap for that. But their job is to protect you. And they know what the market is. So let's just say the market is $500,000. Well, every seller thinks they can sell for $520, $540, $550. They think there's a market. And the market, if you put your house on the market at the market value, you're going to sell within a certain time frame. And it is a little longer now than most, but usually it's within 30 days. Florida's hit the highest it's been in a very long time. I think it's 53 days right now in Florida. And I watch these things. So if you put your house on the market at fair market value, there's a time frame in which you'll sell. However, if you're holding out for that 550 and your market is 500, an investor is going to walk in and go, hey, listen, I'll give you exactly what you want as long as you do it my way. And their way is usually very sophisticated. It's like straw man loan, which means you continue your loan. And I'll pay it for you. Now, is that advised? Never. No. But it'll sound like it's a good deal. So the investor, their job is to really understand this stuff and kind of get over on you. And they usually utilize greed in the process, and there's no way you win in this scenario. So you have to be very cautious, because the investor, their only job is to make as much money as they can. They don't care about you. They don't care about anything. They don't have a fiduciary responsibility to protect you. They don't have a license. They don't have anything on the line. They're just trying to make money, and if they can make you believe something, they'll make their money at your expense.
The other thing is your agent. I don't want to shoot at your agent. I don't know who your agent is, but what market are you in? Where do you live? Because for a house to not be able to sell only means a couple things. One, it's priced wrong. It's absolutely priced wrong. And I don't know if they became your agent because they promised you they can get you a lot more for your house. Or two, what's the condition of your home? So if your condition of your home isn't meeting the financing guidelines, maybe it has health and hazard issues, maybe it's really run down.
You need a roof.
And if that's the case, your pricing is wrong once again. So your agents, if he's not selling the house, he or she, I would question the agent, and I would figure out what they need to do in order to get that thing sold. So there's your other piece. And if you need a good recommendation to an agent, all of you, we can hook you up.
Yep. Gloria. Go ahead. Gloria.
Is it better to go through a down payment assistance program or pay out of pocket?
Gloria. Gloria. Come close. I'm about to tell you. Always better pay out of pocket. Because the down payment assistance programs always have a catch. There's some catch. Most of them are just silent seconds, which means there's another loan on your property. Most of them are. But some of the catches are like ridiculous. I'll give you a for instance. Gloria, there's one that sounds amazing. It's called Dream for All. California put out Dream for All. California advertised the heck out of this thing. They said, hey, you know what? You can own a house and California will help you with 20% down. That sounds amazing. Like amazing. So you're buying a $500,000 house and California's going to help you with $100,000? That's amazing. Wow. I can't believe that. So when you dig in deeper and you say, okay, California, I want to buy that $500,000 house. Like, cool. I'm going to help you with 20% down, $100,000. $100,000. And then you're like, hey, okay, cool, let's do this. Cool. California's like, hey, you got your house. It's worth $500,000. We now own real estate together. And you say, all right, that's me. What do you mean we own real estate together? Oh, yeah, I helped you with that $100,000. It wasn't a gift, and it wasn't free. I want my $100,000 back. Wait, Mr. California, what do you mean you want your $100,000 back? Yes, I want my $100,000 back. And I want interest. No, never mind. In a California, appreciation's way more than what I can charge in interest. I want shared appreciation. Wait, what? You want your $100,000 back and appreciation? So California's like, yeah, we're in business together. I'm really happy you got a house. Amazingly happy. That's amazing. When you pay me back, I want my $100,000 plus all appreciation. Oh, by the way, if only one of us gets to get out whole, it's me. I get out first. But state of California, what if I'm poor, like really poor and barely can make it? If you can prove it for the last 3 years, I might let you get out for a little bit less. But if you're even reasonably stable, I get out first. I want my appreciation. But great news, we own real estate together. Now, Gloria, that's real. It's happening like right now. Does that sound like a wonderful situation? I don't know. If it makes a difference between you not owning a home and owning a home, I say use it. But all things being equal, you're way better off using your own money.
I agree. And that answers the question for B. Andrade. There's a little bit of data for Dream for All. I'll be honest with you, it's my least favorite down payment assistance program.
But it sounds amazing.
Well, it has all the marketing behind it. So California put a bunch of money into an account and acts like they're trying to help everybody in the state.
And
that's not the truth.
Naive loan officers, oh my God, they grabbed this thing, they printed flyers, they started telling everybody about it. They're like, hey, California's going to help you get a house 20% down. Hey, they started putting out media, and I'm watching this going, oh my God, this is insane. I don't think these guys have actually read the guidelines. Because if you read the guidelines and you actually tell this to your borrower, most borrowers are going to go, ew, that's not so pretty.
Well, it's good bait. It's good bait to put on a hook. And for a lot of people who aren't in the industry that don't know the guidelines or understand the programs, for a loan officer, it's a very low end of getting people interested to use them as a loan officer. That's my opinion. It's putting a few people into houses, so that's good. But once again, based on the details he just gave, there's other down payment assistance programs that don't have all that drama. They don't have all that shared appreciation. That actually have more lenient guidelines because on this one, you have to go conventional. You have to. There's no FHA. So getting conventionally approved, you need a much stronger FICO score. No derogatory in the past 2-3 years. It's a tough
and
file
there's
to
an
get
AMI on
approved
it too. There's an AMI on it too.
Donnell Shaw said, "You shy."
So Donnell, here's one of the things that it's a beautiful benefit of us doing this because we do it every day, and we get people shooting at us. And you know what? Sometimes they make me question my knowledge of guidelines, but because they come shooting at us, we're ready, man. We know the stuff. If I even think I'm a little bit hiccupy, I'll look at him and he'll go, "That's right," because we check each other. We're both licensed loan officers. We both close loans every day. We both work on loans all day. But there's a whole bunch of guidelines out there. And I was on the phone yesterday with a realtor, and the realtor started questioning, like, why would you use FHA instead of conventional? Why would you? And I don't usually get that from a realtor. And I went, oh, whoa, all right. I get this from opposing and people coming at me. They're like, why would you qualify the client FHA? And I'm like, well, here's why. they're like, hey, conventional, the MI falls off at a certain point. And I was like, you're correct. Well, MI does fall off at a certain point, and certain borrowers would be way better off. But in this situation, it was better to go FHA, and I justified it. And then I realized, you know what, that realtor might actually be looking after the client. So I'm not upset about it, but I'll tell you what, when they come at you and you're like, oh, wow, and then you're like, no, I got it all, man. I've got the skills. I got the training. I can answer these questions correctly. If you're coming at me maliciously, God help you, because it's not going to end well. But if you come at me honestly and you're trying to protect your client, amazing. Let's do it. I want to protect my client too. I actually got on the phone after, called the client, and I said, hey, listen, I just want to let you know that your realtor hit me with these questions. I'm not upset about it, but it's just out of the ordinary for me to get hit with these questions. But I'm looking after you, the client. My fiduciary responsibility is to you, the client, not to the realtor, not to the builder, not to the seller, not to anybody else, but you, the client. And I make them real clear, you, the client. So, Donnie, am I shy? Nah.
Also, you guys need to know that in the transaction, the real estate agents, I love all our real estate agents that we work with, but real estate agents by far or by large like to act like they're the boss. Okay? They're not the boss. You know who the boss is?
You are.
You're the
He's
boss.
not the boss. I'm not the boss. Escrow's not the boss. You have to remember, you are the client. You're paying everybody. You're paying your realtor. You're the boss. His job is to advise you. His or her job is to advise you. And you could choose to advise or not take the advice. Either one. Same with the loan officer. When it's time to lock, I'll tell you, hey, listen, here's the matrix. Here's what I would do. Here's what I think is going to happen. Here's. But here's your options. You're the boss. You tell me what you want to do. And occasionally they'll say, Lee, I appreciate your input. I'm going this route for my own reasons. I'm like, cool. You're the boss. I will do it your way. You're in charge.
Right. Gloria Marin back.
Hot there, man.
I know, dude.
Yeah.
My husband just opened self-employment business. Would it be the right time to start buying a home?
Gloria, it's probably the worst time to start buying a home. Do you know why? Here's why. Because if he just opened a business, we don't know how he's going to report. We don't know how that business is going to do. We don't know what the income is. Now, there is a caveat to this. Let's just say that you're a doctor and you make $400,000 a year, and he started his fly fishing business and it's brand new, but you never really counted on his income anyway. I actually have a client that does this, and she's a doctor and he started a fly fishing business. And so because we're using your income at $400,000 a year, I would go, okay, cool. Can't use your income, but the good side is I don't have to use your loss either. And because of that, I can go straight off of yours, add him to the deed a little bit later, and we're good to go. Slight difference in a community property state, but pretty close to the same.
Barrow, outside San Antonio, Florida. Okay, so you're just outside of Orlando, just a little west of Orlando. About how far is that from Orlando? So I think that's probably a good market. So I'm going to say you need to talk to your agent. You need to talk to your agent, have them show you the comps, have them show you what the prices are actually selling for the houses in your area, and then readjust that purchase price, and you shouldn't have a problem. As long as the purchase price is accurate, I think that's the case.
User 2716, can I qualify for a home loan with a timeshare collection?
Nobody likes those timeshares.
Nobody likes the timeshares, and they're so ugly, and they're ugly on the credit report, they're ugly long term. They look great when you're in the resort, and that timeshare salesman, man, they get trained to hardball close. These guys are pretty good. I've been through a couple of timeshare pitches. I'm like, yeah, y'all are pretty good.
I don't even think the deals are bad. I think they make sense if you're going to use it.
Yeah.
If you're really going to
It's like a
use
gym
it.
membership. It's
Exactly.
probably a good idea if you use it.
Yeah.
But if you don't, you could probably buy that same hotel for way cheaper than what you have to pay on your maintenance fees, because they tell you those will never go up. They go up. There's actually an entire industry of people trying to get people out of timeshares. The answer is yes. If you have a timeshare collection, I have to know is it full collection. If it is, then I have to put a certain number in, use a percentage of that, and move forward with the loan, just counting it against your debt to income ratio. If it's below $2,000, I can ignore it.
Yeah. There's also a secondary market for this, guys. So if you're thinking about not paying your timeshare or want to get out of it, you can put it on the secondary market. You're not going to get everything that you paid into it, but someone else will take over the debt for you guys. Sandra, CHS Realtor. How can I become a referred partner? I'm in South Carolina, Charleston area.
Sandra, you started already. Good job. Sandra. If you're a good realtor, and even if you're not, if you're brand new and you're just learning the process, we work with realtors all the time. We do get our favorites in certain areas. I got my favorite in Austin, Texas. I got my favorite in Dallas, favorite in Houston, favorite in Riverside, favorite in San Diego. I've got my favorite realtors. But if you're a good realtor, we'll work with anybody. There's guidelines, and as long as if you're looking out for your client, I'm looking out for your client, it works out really good. However, we do get a lot of loans all across the country. So if we have somebody like you in South Carolina, someone like you in South Carolina, and we get a loan in South Carolina, we go, okay, they're like, hey, Chris and Lee, can you help me find a realtor? I really need a good realtor. And like, where do you live? Charlotte, South Carolina. I'm like, hey.
Charleston,
South Carolina. Hey. Yeah, Charleston's North Carolina.
North
Carolina.
Wrong Carolina.
Sorry, I get the Carolinas mixed up. Don't do that. Don't mix up.
I heard vacation in there is pretty cool.
Badass.
Yeah.
So then we go, hey, here's a client. Will you have the time to take them on? Because I'll call you. I won't just send it to you. I'll call you. Will you have the time to take them on and give them the proper customer service? Here's why. We work really hard on our reputation, our value, and our footprint. And it can be destroyed by a bad realtor. Now, if you're new, that doesn't make you a bad realtor. It makes you a new realtor. And I actually ask people, I say, hey, if you're new, please just be honest with me because I can coach you through a lot of this stuff. And a lot of the coaching is simple 101 stuff. And sometimes I tell you, call your broker because some things are broker related. But, yes, we want to work with you if you're a good realtor.
And are you close to the Outer Banks? I heard the Outer Banks is a cool spot.
Dude, I saw the movie.
Bono's Lifestyle. Thank you for the love.
Series. What's a Bono's?
The Guzz. That's wild. Wow. What's wild?
I don't know. Wild.
What did we talk about that was wild?
Maybe too much caffeine.
Gloria. Oh, my God. Thank you so much.
Gloria, we're here for you. Gloria.
Reg. Pablo. Reg. Thank you for the love.
Sharing the video. Sharing the love. We appreciate you. Bang, 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 bang.
Kathy Ortega. Is it easier to qualify for a home if the interest rates are lower?
It's
2020-ish?
Yeah. So you qualify. It's not easier or harder. You qualify for more or less. So the interest rate determines your purchase power. However, it's going to affect the market because now that interest rates are high, not a lot of borrowers can qualify. So let's just say we get 100 people this month trying to apply for a mortgage. Out of those 100, 10% will qualify because they have enough income, assets, credit, and everything. So 10%. So the other 90%, that's called pent-up demand. They can't qualify just yet, but they still want to buy. And as soon as rates come down, they're going into the market. But only 10%. Well, you got a $500,000 house, and only 10% of the market is qualified to shop. That's technically a buyer's market, which means you can buy more house. The payment will be higher because the interest rates are higher. Mm-hmm. However, when the rates go down to 4, all 100 will now be shopping for that $500,000 house. And you'll have 10 offers the first weekend. And 10 offers mean the price starts to drive up and you don't get favorable terms. So, all things being equal, if you can qualify right now, this is the best time to buy.
Heck yeah. Baby. My name's Baby. Nobody puts baby in the corner.
Yeah.
How much does need down if the house is $150,000? I'm
going to say this as non-derogatorily as possible. Baby.
Yeah, baby.
About $8,000.
Yeah, baby. Reg 9871. What credit score should I be at before I even consider buying a house?
Reg. The first thing you have to say is, do I want to buy a house? Because if you do, then we start working on all the pillars. And there's only 3 pillars. There's only three legs, 3 pillars. The one that you probably need to work on, credit. That's a big pillar. It's not a small pillar. It's a big pillar. Next one, income. How much is your income? Yeah, whatever your job is, that's what it is. And you can maybe help that a little bit, not a lot. And then assets. How much you have for down payment? So credit, I can go FHA 580 for 3.5% down. I can go all the way down to 500 if you put more than 10% down, 10% or more down. Fannie Mae, Freddie Mac, 620 If you're a veteran, your FICO score doesn't matter. There's no FICO requirement on a VA loan. USDA, help me?
580.
580.
But that one's tiered too, so that one's extra tough. That's probably the hardest loan to get in, guys. Redhead, is buying land harder than buying a house?
No, they're about the same. You write a check, you walk away with your land or walk away with your house. Getting financed is a whole different game. If you want to finance land, you need 50% down as a rule. What? Did you see that right? 50? Like between 49 and 51, 50, not 15? Yeah, between 49 and 51, 50. As a rule, you need 50% for raw land. Why? Because it's not easily sellable. It's not a highly marketable product.
Yeah, that's what that song says, buy dirt. Eric, 7785, what can go wrong with buying a property in a trust?
So, like everything on the planet can go wrong. First off, if you're talking about a traditional, they're called conventional conforming mortgages, and that's FHA, USDA, VA, Fannie Mae, Freddie Mac, a few others, but that's the majority of them. If you're talking about those, you can't buy those in a trust. You can't. They are financing a human being, a person. This is a person's property. A lot of people think you can do things in a trust because it's cute and it's all that. But if you're buying something in a trust, that's a corporate loan. Because the corporation, the trust, is actually buying the property. And the corporation has its own taxes. We actually have a corporation. The corporation is called, get this, Chris and Lee.
Fancy.
Inc. And every year we have to pay taxes on it. Have to pay for a CPA. We have to pay all kinds of stuff. And that corporation has a credit score. And that corporation, if it's buying a property, has to do how much income was, how much loss, blah, blah, blah. It cannot be Lee and it cannot be Chris because it's doing it through the corporation. Those are corporate loans. So a lot can go wrong. What can go wrong? Everything can go wrong with a loan. Everything. You could lose your job the day of funding. It's over. You're not funding. We can find out you're divorced 1 week before we close. You're not closing.
Yeah. And those are baller transactions. So if you're a baller, maybe we can make it happen.
Yeah.
Smurfy, get ready to build Bernardo. Land not paid off yet. Should we get a construction loan?
I don't think you have a choice. If you're ready to build a barn-dominium.
Oh, Barndo.
Yeah, Barndo. If you're getting ready to build a barn-dominium, you have two choices. You can pay for it cash or you can get a loan. You cannot get a regular FHA, VA, USDA, Fannie Mae, Freddie Mac because it's a Barndo. If it was a SFR, single family residence, there is something you can do called a one-time construct. One-time construct is on FHA, VA, and USDA. Not Fannie Mae, not Freddie Mac, but one-time construct, VA, FHA, USDA. But because it's a Barndo don't sit in those categories.
I think there's something coming out, though, so keep in touch with us. We'll let you know.
Yep.
Sandra, hey, y'all.
Hey, what's up, Sandra? Sandra the realtor.
Redhead, is it better to pay off debt before trying to buy a house like $15K in debt? That's not a lot, man.
You take that.
That's not a lot of debt. It's not a lot of debt at all. Here's the thing. That $15K in debt, is that a car payment? Is it like $400? That's very normal. That $15K in debt, is that credit cards? Like $600? Pretty normal. Now, depending on how much money you make is going to be the deciding factor. How much money you actually bring in versus how much debt you have going out is the deciding factor. So debt is relative. I would say $15K. Don't pay it off. Consult with us first. We can run all the numbers, guys, so we can build scenarios that don't exist. I can build a scenario right now without you doing anything, with your income, paying off all the debt, what it looks like, keeping the debt, what it looks like. So always consult with us first before you make moves of paying debt, whether that's regular debt, collections, charge-offs, whatever it is. Talk with us first. We'll let you know, because here's what clients do often is they'll call me and say, hey, I paid off all my collections and I wanted to qualify. What you've done is you've actually reignited the reporting on a lot of those debts, which can bring down your credit score.
What? Okay? If you pay off a debt, it goes down?
Sometimes. Not to mention that you think
I already knew that. It was just for dramatic.
You think it's an act of collection, but here's what happened. You went and borrowed money from Citibank, got a credit card, right? Credit card, 10 grand, maxed it out, couldn't pay it anymore because you hate hard times. and they chased you for a little bit. Citibank will chase you for a little bit, but then they'll give up. And when they give up, they usually charge that debt off and then sell it to a collection agency.
What?
A third-party collection agency.
I knew that too.
Now that third-party collection agency is now calling you saying, you owe us money, you owe us money. But they've already charged it off, which means by contract, you don't owe Citibank that money anymore because they've already charged it off. And now you're going to pay the collection agency when you didn't even need to. And now you've updated the collection reporting, which is bringing down your score. So now you got hit with a double whammy. You paid money you didn't have to, and you ruined your credit score. So consult with us first. We will guide you.
Double whammy?
Double whammy.
All right.
Whammy! Remember that movie?
Yep.
Redhead, Smurfy, it's hard.
How hard is it to buy land? Smurfy at Smurfy. How hard? Well, it's actually pretty easy. It's really easy. You write a check. If the land is $100,000, you write a check for $100,000. You own the land. It's that simple. A little bit of transaction through title and everything. How hard is it to finance land? That's hard.
Smurfy said they bought land 30 acres 2 years ago and it was easy. So
Okay.
in that case, he was able to write those checks, yeah.
Yeah, if you can write the checks, badass. It's pretty easy.
Eric, what can go wrong with buying a property in a trust? We already answered that
We
one.
did that one, man.
Miss Jasmine would love to network. South Carolina, I'm currently in Nashville looking for a vacay rental. Look at that. Marrying
Look at
people
we're
up.
connecting
Marrying
people.
them
It's
up.
amazing. Hey, tune in to us. We will help you with the guidelines across the country. We deal with loans all across the country. We dig when realtors are in here. We dig when loan officers are in here, title people. We get some underwriters. I tell everybody, come at me. If you think my guidelines are off, let me know. I'll research it. I'll find out because I go live. I'm serious about this stuff because I'm live on a platform. And the only way you can do live stuff is you actually know your shit.
Yeah. Sandra said they filmed Outer Banks right here.
Someone got a haircut. Yeah, Outer Banks right there. Dude, Outer Banks was a really good...
I never
The
seen it.
first month or first year was the first series. I don't know what the
Oh, I've seen that.
Yeah, first year series is pretty good. Second year, third and fourth started to fall off. But it was a really good series. I didn't even know this place existed.
Was that the murder mystery one?
No, it's about the kids and the dad was... I don't want to blow the
right, I'll
storyline
watch
for
it
you.
then.
But yeah,
I'll watch it.
the kids, it was a pretty good one. And I'm like, does this really exist? And like, it evidently does.
Whoville hater, someone got a haircut.
Who? Which one of us? You.
I went to Braids
Yeah, I
and Fades
didn't even
yesterday.
catch- I didn't even-
Braids and
I didn't even
Fades.
catch it. Like, I see this guy every single day. I'm like, yeah, whatever.
Crystal 1983, can you break down the difference between realtor, broker, lender?
Oh, Crystal. Here we go.
You might want to throw a loan officer in there.
Yeah. So there you're mixing a couple of things, but I'm gonna clean it up for you, Crystal. You gotta grab a pencil, a number 2 pencil, and then you got a backup pencil in case that one breaks down, and then maybe you have a pen in the background. Okay. So, realtor. The realtor is licensed. They should be licensed. Only deal with the licensed realtor. And their job is to understand real estate, contracts, laws, and all kinds of stuff. I'm going to put us in California, but it's a little different throughout the country. I'll explain that. So a realtor gets a license in California, and they either sell the property or they help somebody buy the property. But a realtor in California is actually the employee of a broker. The broker has to have an E&O insurance policy, errors and omissions. So the broker has to have so many years in experience. They have to put up some stuff, some bonds, and they have to really kind of know their stuff. So the realtor is the employee of the broker, although it's an independent contractor situation, not technically an employee, but if there's a problem, you will go to the broker, and brokers solve things together. They broker to broker, not realtor to realtor. That's not the way it works. However, that realtor's job is to understand buying a house or selling a house. Now, if you're a realtor in California, you're a member of CAR, California Association of Realtors, and you have access to the CAR contracts. The contracts are already a template way of buying things. So the realtor protects you from the real estate side. Good. So broker. There's broker in that connotation, which means the realtor works for the broker. Now, the lender. The lender is your loan officer. Your loan officer is like Chris and I. We are NMLS license 944254.
1066958.
So those are our NMLS license numbers, and we have to pass a test, put our thumb down with the FBI. They have to make sure that we don't steal money, that kind of stuff. But then we're licensed to build a loan. And we are what's called a direct lender, So we work for New American Funding, and we're direct lenders for New American Funding. But then here's this word again. We can broker loans, which means I can broker to Wells Fargo. I can broker to Chase. I can broker to AmeriHome. I can broker to a lot of different loan company. So there's that broker. Now there's another side of the lender business, and that's called broker. That's when you don't work for a direct lender. You're literally a broker, and all you do is broker loans. So when you're talking the word broker, there's different connotations and different ways to approach it. There's the broker for the realtor, who's the boss. There's us brokering a loan, which means I sell a loan to Wells Fargo. I can do that. I do it out almost every month. Wells Fargo, I sell a loan to Wells Fargo. And then there's the broker in the lending business who does not work for a direct lender, and brokers get to choose their commission. They get to choose how much money they make off of you, and they get to choose who they send the loan to, and that's going to determine your interest rate and how much they get paid. That was a lot of information. I hope you had 2 pencils.
Mr. Chicken McNugget, thank you for the love. Ashley Romero, do we know you? You sound familiar. How can I get my name off a mortgage loan?
Yugo.
Yugo is a car.
Yugo, it's not anymore. It used to be.
No, it still is a car.
Isn't? It's still a car, just not a company anymore.
Mine is a company.
Yeah.
Okay, so getting your name off a mortgage. So here's what happened is you and another person went on a mortgage, okay? And the bank said based on your income, your debt, your income, your debt, your credit scores, you can afford this much loan. So the bank let you guys borrow money based on all of this data. Now you can't just take one person off unless they verify that this one person can do it alone, okay? So the easiest, freest, simplest way to do it is to try and see if that one person alone can assume it by themselves. That's the easiest, simplest way to do it. They can try to assume it themselves and takes you off, which means you come off the loan, you're probably going to come off title, and you have no more access to that property. But the most popular way and the most traditional way and the way that can always be done is if this person removes themselves and the bank, like a loan officer, does the credit worthiness of this person and says, okay, this person's credit, this person's assets, this person's income all together qualifies for this loan on their own, then we do a refinance.
Rate and term refinance.
So we refinance this person, just them, on the property, and you will come off the loan, you will come off the property title, and it's just this person. So there's a couple of strategies to do it. The first one, assuming it, very difficult, very hard, probably not going to go through. The refinance is very possible as long as that one person makes enough money to carry that loan on their own.
And Ashley, I've heard of assumptions taking 9 months right now because people are like, hey, I don't want to refinance because the rates are high. Well, then we'll assume, and they think that there's a time frame. There's no time frame. The banks don't care, and there's nobody incentivized to push it. So if we originate a loan, let's say we originate a $500,000 loan, we're going to make a commission. What that means is, hey, we want to fund that loan by the 30th day. Well, if you take out the loan officer, the underwriters, and everybody that's getting paid, there's just somebody in the back who gets hourly no matter what, and they're not incentivized to close that loan or finalize the assumption quickly. I've heard them taking 9 months.
Oh shoot. What? Time for a commercial.
Oh, if you need a badass loan, call your badass loan officers. You can reach your badass loan officers at New American Funding by calling the number on the screen. If you call the number on the screen, if you do it right now, we're not going to answer it because we are live. But if you call it after the live is done, there's a possibility that you can get a house. Matter of fact, it happened yesterday. Somebody called us after the live, sent me all the documents. I got their pre-qual out by the end of the day. They're in contract today. That happened yesterday. That's it. Bye.
Dude, the commercial has to end. Young Married, thank you for love. Jerome Har. What's the process for financing new construction 3 condos?
You take that.
Okay, so you're going to need a construction loan. This is not, so what we specialize in, that we actually put our hands on and down in the numbers and do a lot of the work is real estate financing, okay? Real estate financing, which means you have an existing property or existing house or manufactured home or condominium already on the land, built, stuccoed, roof, everything in it, done. That's real estate financing. What you're talking about is a construction loan, which means you have to purchase the land, go through the process of pulling permits, hiring engineers, hiring architects, hiring all these other professionals, then bringing in the contractors to do the work. And what will happen in a construction loan is it's phased financing. So the first phase is we'll release this much money to do this work. Next is the next work. Next is the finishing. and then you're done.
You just like saying phased financing, huh?
Phased financing.
That's kind of fun. Phased financing.
But it's a process and it's a different way of borrowing money. Okay, we can do here in house is a one-time construction. It's called OTC, which means that you're going to purchase a lot and build a single unit, not 3 condos, not more houses, just a single unit at a time.
Not
and
even
it's
barn
for
dominium.
someone,
I checked that one.
and it's for someone that's going to live in the property. So it has to be for your primary residence. It's not for investors. It's not for anyone like that. But I do have an avenue for you. I'm not going to do it myself. I can marry you up with someone that can help you with that, though, Jerome. So if you want to go down that path, give us a call.
Truck and Dude 23, what's going on with home and insurance?
Woo!
It's a nightmare.
That's an ugly topic.
Truck and Dude.
Ugly
This
topic.
is ugly. It's happening to a lot of people. I get people calling me mad at me. Like big mad. Like big mad. Like one of my good friends calls me up and says, like screaming, "You promised me this mortgage was never going to go up. Or what the hell happened? I just got a bill for $2,000. I'm like, all right, calm down. Let me find out what happened. Let me find out. So I dig in and I'm like, okay, how come this went up $2,000? Well, because the insurance went up $1,000 every 6 months. I'm like, what? Yeah. So I call my friend back and I say, hey, listen, the mortgage didn't move. It's the exact same amount. Can't. It's contract. It's legal. It has to be this way. But there are 2 pieces in there that move: property taxes and insurance. What's happening is in state of California right now, and I think it's happening in other states too, some of the carriers go, hey, your rules are just too much. This is junk. A lot of people are doing this in California, a lot of insurance carriers, and they're like, hey, you know what? California's been real. It's been fun, but it hasn't been real fun. I'm out. Then you're stuck with insurance, and you're like, hey, I need somebody else to sell me insurance, which used to be pretty easy to get. But now that 6 large carriers left California, it's not so easy. So guess what those remaining carriers get to do? Jack up the prices. Now, it's a giant problem. It's a big problem. Not a little problem, a big problem. They are trying to fix it, but in the meantime, unfortunately, the homeowner takes it in the shorts. It's kind of what happens.
Here's the other thing. It's a big money grab, too. It's a huge money grab. So the insurance companies, I don't know if you guys know this, but they're some of the richest companies in the world.
No.
And their modus operandi, you know what it is?
Don't pay.
Profit.
Don't pay.
Profit.
Don't pay.
That's
Deny,
how they-
deny, deny.
So in California, you can only jack it up so much.
Yeah.
There's a cap, and they can't jack it up fast enough and high enough because of a lot of the stuff they're having to pay with fires and natural disasters. Big fires here in California. The fires here suck.
By the way, if you ever get denied by an insurance company, hire a lawyer. Hire a lawyer. Hire a lawyer. Their job, I mean, their
first job.
Their first job is to deny. That's it. They're gonna go, hey, listen, appreciate your claim, denied, and that's it. If you go away, let's say 80% of them go away, they solved 80% of the claim just by putting denied. That's it. Now, if you get a lawyer, the lawyer's gonna dig in and go, all right, not only am I going after this $100,000, but I'm going after punitive damages because I believe you're abusing people. They're like, oh, let me take a look at that again. Approved. It happens.
It's garbage. Sap Rock, thank you for the love. Ashley Romero, we already answered that question. Hector CG, can you explain VA loans?
VA loans, like Dr. Evil. VA loans. VA loan is probably the best loan in the system. It probably is. There is only one downside to a VA loan. It's called a VA funding fee, and it can get very pricey, 3.3% on your second use. But VA loan is probably the best loan in the system. Let me give you a few reasons why. One, VA loan is zero down. Zero down. Zero. How much? Zero. Perfect. VA has no mortgage insurance, which sounds cute. All right, cool. I don't go buy insurance. But what that means is if you were qualified for an FHA for $500,000, that included mortgage insurance. But if you are that exact same borrower got qualified for a VA loan, it'd probably be in the neighborhood of $550,000 because they don't have to buy mortgage insurance. So it increases your buying power. Unbelievably powerful. Super powerful. Zero down. No mortgage insurance. Oh, and did I mention no FICO score requirement? I don't care what your FICO score is. It could be 430. If I get an approve eligible and you meet the back end residual, I don't care what your FICO score is. There is no technical need to consult your FICO through the VA guidelines. There's a lot of very powerful things. That's only a couple, by the way. but there's a very powerful things with a VA loan. So
What's the
hope
negative?
I helped you.
What's the negative of a VA loan? I can only think of one.
VA funding fees, the only negative I can think of a VA loan.
How do you know if that's negative? Because you still get in with zero down.
Yeah, maybe.
And that's actually what I think the negative is.
So here's one thing that appears to be a negative, but it's really not. A lot of times we'll go into contract and they'll say, hey, listen, hey, Lee, my seller doesn't want to go under termite. They don't want to do a termite. Usually, you know why they don't want to do termite? Because they probably know there's termites. And then they talk to the buyer's agent. The buyer's agent says, well, we really like this deal we got, so we don't care if there's termites either. We'd like to waive the termite. Now, the realtor on the buyer's side and the realtor on the seller's side agreed to this. Now, is this really good for the buyer? Probably not. Probably not. Because why would you want to avoid that? If you know that's why you would want to avoid it. VA says, I don't care what y'all say. We mandate a termite. We mandate a termite. So, on a VA loan, the only thing I tell people right away is I say, hey, listen, here's the one thing you need to know. There will be a termite inspection. I don't care what you guys come up with. Doesn't matter. The VA is protecting the veteran, and they're going to mandate a termite inspection. Is that what you're going to come up with? Or are you going to talk about non-allowables?
I love it. No, I love it. Non-allowables are good. There's not a bad thing at all. Justin, 85K gross income, no debt, 150K to put down. Good job, Justin. What would be a very manageable home price?
450 to 500. If you're putting that much down, because the loan amount will probably be 320-ish, 320 to 350, and then with that extra hundreds, I'd say 450 to 480, maybe as much as 500, depending on your property tax base. Property tax base is going to be a very important situation for you.
How's your credit, Justin? Let us know. DD, 30-year or 50-year home loan?
BD, how smart are you and how disciplined are you? Because I'm about to give you a real hack. A real hack is a real one.
Life hack.
So let's say that I do this a lot. People say, hey, Lee, I'd like to know what a 30-year loan is. I'm like, all right, cool. 30-year? Let's just say it's $3,000 a month. All right, cool. I want to know what a 15-year is. They're like, hey, 15-year, I price it out, $4,000 a month. You mean if I pay $1,000 more a month, I will actually pay this off in 15 years? I said, yeah. How disciplined are you? Very disciplined. How smart are you? Very smart. Okay, good. So let me give you this. If you do the 30-year, you'll get $3,000 a month, and then you'll pay it off in 30 years. If you do the 15-year, you pay $4,000 when you pay 15 years. But if you do the 30-year, and you pay your $3,000 a month, and then journal $1,000 a month exclusively to principal, you won't pay it off in 15 years. You'll probably pay it off in 12 and a half. Wait, what? Yeah, if you pay more money to principal, and because the way the amortization tables are set up, the majority of your payment for the first 15 years goes to interest. So you're not actually knocking that principal down. But if you commit to knocking $1,000 a month to exclusively principal, you'll pay it off faster than 15 years. So if you're disciplined and you're smart, I say take the 30-year and apply that amount that you are willing to pay anyway exclusively towards principal. You will get over on the bank. You will game the bank. Yep. They may fire me one day for telling you that.
Yeah. Oh, yeah. Elvis, thank you for the love. Justin, is it okay if a house hack? If not cash flow positive, Denver is just way too expensive to cash flow.
Justin, it depends. Are you looking for your home, your primary residence, a place to live, or are you trying to be an investor? If you're trying to be an investor, if you're in a metropolitan area like Los Angeles, Denver, Miami, New York, Chicago, those numbers don't number out. The math doesn't math. It doesn't work. I've seen it. I've run the numbers 1,000 times. There are people saying, yeah, this is a good idea. No, but if you're looking for a place to live, if you need a place to live, and you have the choice between owning it and buying down that mortgage payment or renting and buying somebody else's mortgage payment down, all day long, own it, even if you're house hacking.
Heck yeah. Jazzy, user, Jake, thank you for the love. Ashley Romero, I've talked to him before. Talked to who, me or him?
I don't know.
Alondra, my boyfriend and I are thinking about buying a house together. What would happen if one dies or we separate?
Well, you get a new boyfriend. Duh.
I'm going to say this is the best scenario for you, Alondra. And I'm going to say...
Am I wrong?
Don't get married. That could hurt things. When buying a house. But what did you say?
I said, what happens if one of us dies?
Okay.
You get a new boyfriend.
Yeah, just get another one.
Yeah, you get another boyfriend. It's
Alondra,
easy.
I'm sure you're a cat.
Alondra,
Just get
it's easy.
another one.
Yeah, just bam, just like that. Boom, boom, just like that. So here's how it works. When you take possession of a house or you finance a house, let's just say you're in California. So if you're in California, you have the ability to take possession two ways. JTWROS. That's joint tenancy with rights of survivorship, which means if one of you dies, the other one gets it. That's what that means. The other way to do it is tenants in common. If you do tenants in common, then you own half the house and he owns half the house. And if one of you dies, it goes down the lineage to blood or relative or whatever that person designated. So there's two ways to purchase this. Now, the hard part is the loan. Because you both qualified for the loan, you both own the house, you're both liable for the loan. So if you separate and y'all get new boyfriends or whatever.
Is that why they broke up?
I don't know. So if y'all get new significant others, that's a better way. Significant others. If y'all get new significant others, you get a 4-bedroom. So you are still liable for the loan, even if y'all aren't all in love anymore. You still are liable for the loan, and you still own the house. It's a business transaction. They don't care if you were in love. They don't care if you're not in love. They care that you entered into a contract, and in 30 years, you guys will have paid this contract off. So one of you will either have to buy the other out, refinance, assume the loan. There's many ways to deal with it. It happens. We deal with it.
Yep.
We'll help you.
But get the house, because if it doesn't work out and you end up selling, you walk away with some cash. Yes. SAPROC, where are you guys based?
We are based out of Riverside, California.
See, you changed it up.
Yeah,
Instead of saying located.
Yeah, I know. He
located.
changed us.
Based.
He's like, snipe.
Yeah,
he's
good job.
Good job. You sniped us. We do business in all 50 states, all 50. We got more transactions going out of state than we have in state right now. That's the truth. We got them in Vegas, Texas, Tennessee. I think you got one. Where's the other one? Jersey. I think I got one in Jersey.
Jersey, Florida.
So we got more transactions in outside of California than California, but all 50 states.
Yep. User Alex R. How can I buy a house with a very low credit score?
That's easy, Alex R. A big fat bank account, a big fat one, like a fat one. Like you want a $500,000 house, that bank account will be so fat you could fit $500,000 in there without blinking. Now, to finance it, probably not going to do very well. you're probably screwed.
Down
Yeah,
payment.
you're pretty screwed. You're
20% down or more.
Yeah, you're kind of screwed.
And you're not going to get the best interest rate.
Big fat bank account, but you can if you have a big fat bank account.
Liz, can I get a loan with ITIN?
Yes, you can. ITIN, all day, air day. All day, air day. What's the downside? 20% down. You're not going to get a 3.5% ITIN. They don't exist. You're not going to get a 5% ITIN. You're not going to get a 10% ITIN. I think there's one 15% ITIN, but you have to have like 800 FICO to do that. So it's rare. 20% down, ITIN.
Moon Goddess, laughing in Florida, who just bought a house. Yeah, the insurance down there in Florida. But Florida itself as a state, I love it. Good job for buying in Florida.
Yeah, DeSantis is he's done some pretty good stuff. Let me tell you about from a real estate side. Don't forget the politics side, just from a real estate side. In California, we get squatters. What's a squatter? Squatter says, hey, that's an empty house. I'm going to go live there. Breaks in, puts his toothbrush there. Legally, they can't kick him out. What? That doesn't sound right. It is. It's horrible. It's horrible. And if you happen to be the landlord that said, hey, I'm trying to rent this thing out, and then before you got a renter in there, you got a squatter, you got to legally get rid of that squatter. And California, for some stupid reason, protects the squatter. I have no idea. It's so stupid.
California's stupid.
It's stupid. But state of Florida said, hey, we got same-day squatter removal. You got to prove you own the house, prove they're in there illegally, unlawfully, and then the sheriff will go over there with all their might, billy clubs and pew-pews and whatever they need, and they'll get that squatter out for you.
Hell yeah.
So,
or
for
you
those
can do
of
it
us
with
in the
your
real
pew
estate,
pew.
no, I wouldn't do that.
No, the sheriff said so.
No.
The sheriff said
I
so.
don't know how to do it. So, anyway, we're big fans of Florida for that reason because, hey, these are hardworking people. They bought a house. They're trying to rent it. They're trying to build the American dream. The last thing you need is some freeloader piece of better back off. Last thing you need is some squatter squatting in your house.
What if this person was squatting in your house?
Dude.
I'd be like, get out! PR baby G
This guy's
underscore
squatting in
407
our house.
PR.
He's squatting in our house. He ain't paying no rent. He's squatting
Actually,
in
we
our
write him a
it's
nice
the
little
people's
salary.
house.
I had to buy my Corvette. Same insurance crisis here in Florida. You were right, baby G.
Yeah, it's horrible.
It's crap, but that's okay. Florida's a cool state. User Alex R. How can I build up my credit score?
Alex R, here's the hack. Here's the big hack. Watch us every day. Watch us every day because you're going to get little tips and tricks. But here's the most important thing, Alex R. I'm speaking to you as a man who destroyed his credit in his 20s. I thought, screw everybody. Yeah, they said, screw everybody. What are you going to do? Chase me? Yeah, they'll chase you. Yeah, they will. My story is I was in the Navy and I was in San Diego and they had a electric bill that came at me for $383. And I said, you know what? I'm moving back to my hometown of Santa Fe, New Mexico. What are you going to do? Chase me? They didn't chase me. They don't care. But 20 years later, when I moved back to California, I said, hey, Edison, remember me? We're old buds.
Thomas Edison?
Yeah, Thomas Edison. He was my friend.
Nice.
So I was like, hey, remember me? We're old buds. Yeah, I need some electricity. They're like, yeah, you screwed us over. So in order to get electricity, we'll give it to you. We need an $1,800 deposit. I said, 1,800? That was only 300. Yeah, that was 320 years ago. We don't trust you. And I said, well, 1,800? Yeah, you got no choice. You have to. So I did. I wrote them an 1,800 check. They said, no worries. After 12 months, we'll give it back to you and we'll put good credit. I walked away from debts like a dumbass when I was a kid. I think a lot of people do. But here's the truth of it. I earned that low credit score. I earned it because I defaulted on debts. The way you get a good credit score, borrow some money, pay it back the way you promised you would pay it back, and you will get a good credit score. There are many other things you can do. We got lots of hacks to help you grow that credit score. But the most important thing is if somebody lent you money to buy a car, credit card, Skechers, I don't care what you bought. Skechers. He's young, man. I'm pretty sure of it. So pay it back on time.
You think you were Skechers?
I don't know, man.
Come on. So
Okay,
yeah, here's one hack. I'll give you one hack.
Tell me.
Pay your credit card balances down.
That's what he just said.
You didn't say it was a hack. You just said there's a lot of things you can do. But that's the one thing that you can work on right now that'll absolutely help.
Okay.
A-Dub, my favorite Chico's.
Appreciate you, A-Dub.
Is
Appreciate
Chico
you.
a shopping store? Hector CG, thank you for the love.
Appreciate you, Hector.
He also said, I appreciate you guys for talking about VA loans. Thank you.
We are here for you, Hector.
Our
Hector.
pleasure. Our
Justin
pleasure.
says 710
Dude, Justin's
FICO.
a catch,
Justin
bro.
just like, he's like,
Justin's
look at
a
me, I'm
catch.
badass. I'm
Justin,
flexing.
Are you in a relationship? Because if not, ladies, this guy has a 700 credit score.
We hook
money in
people
the
up all
bank.
kinds of different ways.
Man, he's got it going on.
We got realtors talking to realtors trying to refer. You're over here playing Love Connection for Justin.
Hey, man, I'm all about that.
People going to be flying in to meet Justin.
Ladies,
Dude,
Mr. Chicken Nugget, can I assume my mother's 1.9% mortgage when she passes? What? 1.9?
Mr. Chicken Nugget. Okay, this is complicated, a little complicated. So, when your mom passes, if she's got a 1.9, that's amazing. That's amazing, amazing. I don't even know. My brain is trying to figure out how do you get a 1.9. I think there was only one time in where we were in the 2.5 and you could have bought to 1.9. I think just one little blip where that could have happened. It's probably a 3-month time frame in the last 40 years. But if she does have a 1.9, can you assume it? Maybe. Because when she passes, okay, there's the hospital and everybody's going to send out a death certificate, so it's going to be public record. The bank's going to give you some time to grieve. They're not going to ask for your money right away, but they do want their payments. Then you're going to go, hey, this happened. I'd like to assume the mortgage. And they will probably, because of your situation, they will probably say, let's see if we can get you to assume the mortgage. We need your income, last 2 years bank statement, or last 2 years tax returns, W-2s, income. They're going to send you through full qualification. And maybe, if the bank has a heart, sometimes they do, they'll let you assume it. Maybe. There's a lot of maybes in it.
Brianna Taft, thank you for the love. We got
Appreciate you.
ready rapid fire?
Yeah, let's go.
Level Up Mindset said Cam. I don't know what Cam means.
What's
Justin
Cam?
says, thanks, guys. You're
Here
welcome.
for you, Justin.
Crystal 1983. I thought you had to have at least a 580 FICO for lenders, even with a VA loan.
Crystal, you've been misinformed. You're talking to lenders who have overlays. If you actually dig in, this is a common mistake for lenders who don't do a lot of VA loans. They think Dude, I'm trying to rapid fire, but this is important. There is no technical guideline for the VA. I can do a VA no FICO score. I can do it with a low FICO score as long as it's residual. VA is residual driven. Keep going.
Level Up Mindset, personal prediction on interest rates within the next year.
Level Up Mindset. I think we're still going to see reductions in the mortgage I think it might go down to 2. I think he might try to stick at 3, and the latest CPI kind of leaned that direction. So I think he's going to try and stick at 3 just for consumer confidence. But if not, it'll drop down to 2 interest rate reductions. It'll happen in September and December.
A-Dub, what is a conditional loan approval, and what is the timeline from that to closing?
A-Dub, conditional loan approval is if you went through TBD underwrite and you've got a conditional loan approval, that means the underwriter went through, made sure that this loan will qualify. It's usually good as long as you have the same job and the same criteria. If you buy a new car, it's not good anymore. If you did anything to change your debts, it's not good anymore. But they'll tell you 90 days, anything can change it though. If you change jobs, not good anymore.
CD Legacy, I'm in Louisiana. How can I set up my holdings for long-term rentals?
That's a long conversation, CD. You have to tune into us on a different day so we can address that because it's a lot. There's a lot we can do.
El Marie, can I buy while my workers' comp or should I wait until I go back to work?
El Marie, you can do it while you're on workers' comp as long as the workers' comp has a amount, an end date. If it's permanent workers' comp, there's a way to deal with it. If it's temporary workers' comp, it's usually less than your salary. And we have to go with the less amount until you go back to work, and then we can go back to the higher amount.
Jazzy, can you get approved for an FHA loan even with a couple collections?
All day, every day. Cool. We've been Chris and Lee. We are out.